Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are talking about 5 undervalued stocks you should be looking at next week. These are high quality businesses, fundamentally good strong businesses that I believe are trading below their intrinsic values right now. So I'm going to share the bit of details about each one of the companies and of course show you the fundamentals, and of course we are using the Morningstar valuation just to kind of get that, to understand basically if these companies are fairly valued right now, undervalued. But like I said, all of them are undervalued. They have an upside of at least 10% or higher basically moving forward. So let's get started. But before we do that, of course, let's have a look at the S&P 500 and how we're doing for the 1 week. So as you can see, the last week we are up. Everything is basically is up, which is quite nice, and the Dow Jones has actually outperformed to the rest of them, which is quite interesting. I think a lot of that is the UNH, United Health. I think it's done really well. I think last couple of days because of the news, Donald Trump, Warren Buffett is actually buying stock. They bought the stock last quarter, and by the way, the danger of these things is there's a few people that bought the stock, like a few super investors. But remember, there's backward looking that data, so always be careful. What I mean by that is they disclosed that information last quarter. By the way, UNH is not Shariah-compliant, so let's not even talk about it. Let's now look at for the 1 month. So a month we are looking at, everything is green. It actually seems decent. And one thing I actually love this year is the year to date. Look at the FTSE 100. About almost 11% up basically since the beginning of this year, which is really good. And then the Nasdaq is about 13%, almost 5%, 6% when it comes to Dow Jones, and about 10% when it comes to S&P 500. If this was the end of the year, getting it on 10% on the S&P 500, it is really good. That's what we normally say. The total return of the the S&P 500 over a period of time, we're looking about that 8 to 10%. So that getting that 10% is absolutely wonderful every single year. And let's see how it goes by the end of the year, because we've got September coming up around the corner. September is a very volatile month for the stock market. If you haven't joined us in the Patreon account, please do so, where you get access to a lot of things, including the subscriber portfolio reviews. I've now done majority of them. I think I've got 2 more to do tomorrow, and then that's it. In fact, I'm doing that today, this afternoon. So, and then after that, I've got a bit of time. So if you have not sent me your portfolios, join us here and send me your portfolios so I can just give you some feedback, inshallah. And hopefully, my feedback is normally quite, honest, just sort of a feedback, tell you exactly if I think is your portfolio needs a little bit more of this, a little bit more of that, just to kind of give you an idea. Again, I'm not a financial advisor, but I'm just trying to give you my opinion of what I think, basically, especially if you are new to the stock market. So as always, we're going to look at this more or less the same information. Every single one of these companies are undervalued at this point in time. They have an all white wide moat as well, not white, wide moat as well. Equifax is the first one. This is one of the 3 big credit reporting agencies in the US. They collect and analyze credit data that for bankers, lenders, and even employers rely on. Basically, what's interesting about this company is the fact that they have been heavily investing in data analytics and AI, expanding beyond just credit reporting. Earnings growth has been steadily going up. But there's of course there's some near-term economic pressure. The long-term demand is absolutely fine. So it seems a really interesting company to actually look a bit more research. It kind of feels like S&P Global, MSCI, and so on. So I'll be doing a little bit more deep, basically, digging a little bit more information about this company, because it's one of the companies that have been on my radar for quite some time. But the issue has always been very basically expensive. So now looking at it, it looks like it's 9%. It has a 9% upside from where we are. Dividend is actually quite good. So you get less than 1%. The payout ratio 22%. The latest increase is 28%. And then the 5-year growth. So they've only started recently, so they don't have 5-year growth rate. You get $2 every share of this company that you own. Dividend safety of 82%, and profit margin of about 11%. Return on equity of 13%, and return on invested capital about 8%. So that's decent. That's nothing really huge. Okay. They've got a small free cash flow flow. I would love this to be about $2 to $3 billion. That would be absolutely solid. And EPS expected to grow about 21%, which is very interesting. And revenue, I don't think Mr. Market knows this company that well, because it was expecting to grow 21% this next year. This is not 2025, this is 2026. Okay, that is huge. And revenue is expected to grow 10%, but right now it still feels undervalued. If we use fast graph, I use fast graph to kind of give you an idea. Okay, so although we're using the Morningstar valuation, which uses discounted cash flow models, we also need to look at other places, like for example fast graph, to get an idea. So if we look at that normal PE this company has been trading, which is about that 19, based on the normal PE for this type of stocks, based on the earnings, if you like. Okay, because that's the earnings line there. So based on the earnings right now, that 19, it seems a bit basically is expensive. So you will be losing about 4% per annum if you bought this stock right now, which is not huge, but that means, you know, if this stock comes back down another 4-5%, then potentially it is a buy regardless. But if you look at the normal multiple, which is basically where the company has been trading over the last 5 years, which is about that 31 PE, you'll be making at least a 17 to basically percent on top of your money, which is quite interesting. So the $14,534 is what you will have at the end of 2027. So yeah, like I said, it's a very interesting company. I'm going to do a little bit more research on that one. I'll let you guys know. Maybe we'll share it with the community as well. Applied Material is the next one. This one has reported earnings. So they beat both top line, bottom line. But the issue was the guidance for moving forward. They guided slightly lower. I think it was on the revenue side of things. And for that reason, the stock tank, I think, was down about 10 to 15%. I can't remember last time I checked. But 151 billion is a huge company. There's one thing that I do always say to investors: if you are looking at this company, there is, I haven't looked at it lately, but there was some situation with the US government. So you need to basically pay attention to that. But this is one of the leaders in when it comes to semiconductor equipment manufacturing. Basically, they make the machines that produce and chips, basically, which power everything from your phone to AI data and all of these things. So they are very important in company, same like KLA as well as the Lam Research as well. But when it comes to dividend, 1.1% when it comes to that dividend yield, payout ratio 17%, 15% when it comes to that latest increase, the 5-year growth rate of 13%. So they are absolutely huge dividend growth company. 7 years of increasing it, $1.84 is what you get. Dividend safety of 86%, which means it's safe. Remember, anything higher than 61 is very safe. And profit margin, return on equity, return on invested capital is probably one of the best out there. And when it comes to free cash flow, I love that free cash flow, $5.8 billion, which is nice. EPS is expected to grow only 2% in 2026, and revenue about 3%. Okay, but right now it's 19% upside from where we are. $193 per share is where they think the price should be. And looking at fast graph right now, if you bought the stock right now as it is, you will not be making any money by the time we get to the October 2027, and based on that 15 PE. But if you use the normal multiple, which is where the company has been trading about that 17 for the last whatever years, you'll be making about 6%. Okay, so your 10,000 will become 11,400. So because of the growth expectations moving forward for this company, it will be interesting to see, you know, in the next few months, if it goes down maybe another 5 to 10%, then it becomes really attractive. But right now where it is, I would actually say yes, it is undervalued, but if you are expecting huge gains, I wouldn't touch it. Okay, and yeah, it's like I said, it's a great company, and you need to work out what that lawsuit was that they're going through with the US government. I can't remember what they did. But next one is Merck, 207 billion market cap. This is a company that I've spoken about for the last 6-7 months. Still seems undervalued, 32% upside from where we are. $111 per share is where they think the price should be. Dividends are absolutely solid. If we go to fast graph, for example, and look at the expectations moving forward, so that 8% when it comes to the EPS expectation moving forward, if you bought this stock right now, okay, you will be doubling your money by the time we get to December 2027, if everything works out perfectly. But remember, they've got Keytruda, which is the basically cancer drug that is, I think their patents is running out, I think 2028, I think it is. So but they have loads of other drugs that they are working on currently, so let's see how it goes, but you will be doubling your money if you bought this stock based on that. And I think the normal multiple is exactly the same for this one anyway, because it's been consistently trading about 14-15 PE for the last whatever years. So yeah, really great company in my opinion, and one that is basically investors are overlooking. If you have basically space for a one of the giant pharmaceutical companies out there that's going to give you a growing dividend every single year, and of course then you should be definitely looking into Merck. But again, I'm not a financial advisor, don't take my advice for it, do your own research. Next one is West Pharmaceutical Services, 17.7 billion market cap. When it comes to any dividends, it's actually solid, 32 years of increasing that dividend, which means they are a dividend aristocrat. You get 88 cents for every share of this company that you own. Safety 99%, profit margin, return equity, return invested capital really good. Very low for free cash flow, but it's only 17-18 billion market cap, so that's okay. EPS expected to grow about 12%, 6% when it comes to revenue side of it, 26% upside from where we are. Looking at a fast graph, as you can see here, if we look at that 15 PE, it seems very expensive right now. You'll be losing half of your money if you use that normal multiple, basically for the they've been trading for the last 5 years, then you'll be looking about 23% upside from where we are. So yeah, it seems 26%, 23%, not much of a difference. Final one is a Novo, that has the company that has I've literally spoken about every single day for the last whatever months. But it's one of those basically companies that for whatever reason people think they're completely gone, they're just gonna go bankrupt very soon, but that's not gonna happen. Okay, the growth right now, they're expecting an EPS about 4%, 9% basically when it comes to revenue, 35% upside from where we are. Excellent dividend. When it comes to profitability, there's not that many companies out there that can do this. About $10 billion of free cash flow right now. If we go here, let's have a look a couple of other things for this company, because I investors are very funny people, because when these stocks are down, they run away from it. When it starts going up, then that's when you start buying. Right now, if you bought this stock using that basically 15 PE, which is interesting, okay, you'll be making about 16% every single year. So your 10,000 will become $14,227 by the time we get to December 2027. Now, if you use the normal multiple for this one, which is about 31 PE almost, okay, then you will be making 55% basically by the time we get to December 2027. So very interesting, really genuinely interesting. And if you can see here, 2025 we're expecting about 23% almost growth. Next year about basically 6%, whatever it is, then 10%. So it is interesting to see the fact that for the next couple of years, this one says 4%. Let's actually double check with this as well. I want to show you at least for the next 5 years what they're expecting from this company. So that's what we're seeing. This is what I shared with you guys. 2027 is about 13%, then about 8%, then about 15%, and so on. And that can easily change. It takes one of their drugs to start selling fast, or even basically one of the pipelines to actually start selling, because that's the new type of revenue on top of what they already had. And then look at this as well. So nothing to worry about. To be honest with you, I'm happy to buy right now at this point in time and hold it for a long time. I own 100 shares of this company. I own also Merck. So those two I'm going to share with you guys to show you exactly where I am with these two. Merck is actually here. It's gone up a little bit now, about 4%. I do own about 63 shares of this company. My average is like, let's say $80 per share. If we go back, the Novo right now, I'm down, I think about 19%, about £1,000. I own 100 shares, $67 per share. That's basically my average price right now. What I'm going to do is, recently I've said to myself, I'm not going to touch it for a while, but I think I'm just going to start buying one share every other week and just see how it goes. Try to average down while we're still here. Even if I get to 130 shares, perfect. I'm just going to leave it alone, collect that dividend, and let the company do what they meant to be doing, which is basically growing that top line, growing that bottom line, and being the best business out there. When it comes to basically Ozempic or Wegovy and so on, these drugs are not going to go away. There's a massive market for these things, right? Despite the Eli Lilly taking share of the market, I don't genuinely think in the long run this company will lose out, because in the end it's a massive market. We're talking about just the US on basically on its own, they will be making a massive profits just from the US, because the amount of people who need their drugs is basically dramatically increasing. The population is basically increasing. There's a lot more people who are unfortunately overweight and so on, and develop those diabetes and all of that stuff. So in fact, it seems bad to actually wish people to get those diseases, if you like, but it is the nature of these businesses. So yeah, so what I'm trying to say here is basically I'm bullish on this company, and I'm going to hold on to it for a very long time, inshallah. Anyway, I hope you enjoyed the content. If you are, don't forget to subscribe to the channel, and of course like the videos, and yeah, let me know if you have any questions, inshallah. Have a wonderful day. Assalamu Alaikum.